What if the most consequential financial event of 2026 was not a war, an election, or a Federal Reserve meeting, but a signature on a licensing form inside a ministry building in Beijing on the first morning of the year? What if the reason the metal in your phone, your solar panel, and your grandmother's tea service has quietly become a matter of state strategy has nothing to do with speculation and everything to do with a warehouse door that stopped opening as often as it used to? And what if the spectacular crash that erased a fortune in a single afternoon was not the end of this story, but the moment it finally became worth understanding? On the 1st of January this year, China's Ministry of Commerce closed a door that had stood open, more or less, for a quarter of a century. For 25 years, Chinese silver left the country under a quota system, bureaucratic, predictable, and largely irrelevant to the price you paid for anything. That system is gone. In its place stands a licensing regime that treats silver the way a government treats a strategic asset rather than a commodity. Producers must prove a minimum production capacity, demonstrate years of documented export history, and hold credit facilities substantial enough to satisfy state auditors. When the paperwork settled, only a few dozen companies remained standing on the export side of a market that, by some estimates, refines somewhere between 60 and 70% of the world's silver. Sit with that for a moment, because most people did not, at least not right away. A nation that refines the majority of the world's silver decided, by law, to make less of it available to the world. Not zero, less. And in commodity markets, less is a word that behaves like a lit match near dry paper. Stay with me for the next few minutes, because the part of this story that actually matters to your wallet hasn't happened yet. It's still unfolding in warehouses nobody is filming. To grasp why a licensing form could move a market this size, you need one piece of arithmetic the casual observer usually skips. This was not a market starting from calm. Silver had already climbed more than 130% over the course of the previous year, a run so large that gold's own record-setting rally of roughly 66% looked almost restrained by comparison. The world was not walking into 2026 with a sleepy commodity. It was walking in with a coiled spring, and Beijing had just tightened the coil one more turn. Within 4 weeks, silver did something it had not done in the memory of anyone currently trading it. The metal began the year near $71 an ounce, already elevated, already the subject of chatter, and by the 29th of January had touched an intraday all-time high above $121. Gold, dragged along in silver's wake as it so often is, had days earlier set its own record above $5,500 an ounce. For a few charged weeks, precious metals stopped behaving like an asset class and started behaving like a headline. Then came the 29th of January's twin, the 30th, and if you were watching a screen that day, you will not soon forget it. Silver did not correct. It fell off a ledge, somewhere in the neighborhood of 30% in a single session, the worst single-day collapse the metal had suffered since the Hunt brothers tried to corner this very market and broke themselves in the attempt back in 1980. The proximate causes were almost comically mundane for an event of that violence. The CME Group had, for the second time in weeks, raised the margin required to hold a silver futures position, and hours later the White House announced that Kevin Warsh, a name markets read as hawkish before he had said a word in the job, would be nominated as the next chair of the Federal Reserve. Leveraged longs, already strained by the margin hikes, were caught leaning the wrong way when the dollar snapped higher. What followed was not a market correcting a mistaken price. It was a market being forcibly emptied of everyone who had borrowed to be there. The damage did not stay politely inside one exchange. Platinum and palladium were dragged down in the same session. India's commodity exchange ran a special weekend session ahead of its own budget announcement and watched silver futures hit their lower circuit and keep falling. Retail buyers who had piled into silver coins and bars during the parabolic run, the same crowd that had spent years chanting about draining COMEX vaults, found themselves holding positions that had lost a third of their value before most of them had finished their morning coffee. This was not a controlled retreat. It was a stampede with a closing bell. And here is the detail almost nobody put in a headline. The crash happened almost entirely in paper. The metal itself never moved. The financial press, with its fondness for tidy endings, largely called it a bubble that had popped and moved on to the next story. That verdict deserves more scrutiny than it received, and here is why. What happened after the crash is, if anything, stranger than the crash itself, and almost nobody outside a small circle of physical metal traders has explained it properly, so stay with me. The paper price of silver, the number that scrolled across every terminal on January 30th, cratered. The physical reality underneath it did not. That distinction, paper against physical, price against possession, is the entire subject of what follows, and it is worth sitting with, because it explains why a market that just suffered its worst day since Jimmy Carter was president has spent the months since refusing to simply go back to sleep. To understand why the crash did not settle anything, you first have to understand how silver actually leaves a vault, because the two great exchanges that set its price do this in almost opposite ways. The ancient Athenians learned a version of this lesson at Bullion, where state-owned silver mines financed the fleet that saved Greece at Salamis, control the metal, and you control rather more than the metal. Modern China appears to have absorbed the same lesson. When silver is withdrawn from the Shanghai Gold Exchange, it does not loiter. It goes to a refiner, a fabricator, a solar cell manufacturer, and it does not come back. COMEX, by contrast, is a market of promises more than possessions. The overwhelming share of contracts are rolled forward or settled in cash, and the metal that actually changes hands through delivery is a small fraction of what trades on paper each day. That asymmetry produces a number worth watching closely, one the trading desks call the Shanghai premium, the gap between what silver costs in yuan-denominated Shanghai trading, converted to dollars, and what it costs in London or on COMEX. Through much of this year, that premium has run in the range of 12 to 13%. A premium is a magnet. It tells every trader with access to a truck and an insurance policy that buying silver in the West and shipping it to Shanghai is a profitable errand, and every ounce that makes that journey is an ounce that no longer exists, as far as the Western delivery system is concerned. Here is the part that should genuinely unsettle you, and it has nothing to do with a chart. The demand pulling that silver eastward is not the kind that evaporates when sentiment sours. It is solar paste baked permanently into a photovoltaic cell. It is the silver-laced circuitry inside the data centers now being built at a pace that would have seemed like science fiction 5 years ago. The same artificial intelligence infrastructure boom that is quietly becoming one of the metal's fastest-growing consumers. It is electric vehicle wiring, 5 GHz infrastructure, and military electronics. China installed a staggering amount of solar capacity in recent years, and the newer, high-efficiency cell technologies, the ones replacing the older designs across the industry, actually require more silver per cell, not less. Every one of those applications shares a single, unglamorous characteristic. Once the silver goes in, it does not come out. You cannot uninstall a solar panel to recover its silver paste at any price that makes economic sense. This is consumption in the truest sense the word has ever had, closer to burning coal than to buying a stock. India, meanwhile, has been doing its own quiet accumulating. A nation with an ancient cultural attachment to silver, now layering industrial demand for solar and electronics on top of jewelry and investment buying that was already running at record levels. Once silver enters India, like China, it tends not to leave. Two of the most populous nations on Earth are drawing from the identical, finite pool of above-ground metal, and neither is doing so because a chart told them to. The Silver Institute, the most credible source of supply and demand data this market has, projects that 2026 will mark the 6th consecutive year the world has consumed more silver than it has mined and recycled combined. Industrial demand alone set a fresh record in the recent past, and physical investment demand is projected to climb roughly 20% this year to its highest level in 3 years. Meanwhile, mine supply barely moves, for a reason that has nothing to do with silver prices at all. Roughly 3/4 of the world's silver is pulled out of the ground as a byproduct of mining copper, zinc, and lead. Nobody opens a copper mine because silver got expensive. The tail does not wag that particular dog, and it has not for 100 years. And one of the vaults everyone actually watches, COMEX's own warehouses. Registered silver, the only category of metal actually available to satisfy a delivery demand, has been reported at somewhere in the neighborhood of 75 to 85 million ounces through the middle of this year, depending on which week and which tracker you consult. That may sound like a large number until you set it against total open interest, the paper claims outstanding on the exchange, where analysts tracking the ratio have described the leverage in the system as running several times over what the registered metal could actually deliver if a meaningful share of contract holders ever decided to stand for delivery rather than roll or cash out. Most never do. But the entire architecture of a credible futures market depends on the belief that they could. That belief has been tested this year in ways it had not been tested in over 4 decades. Now here is the number that ought to make you set down your coffee. Registered inventory sits far, far below where it stood at its post-pandemic peak, down by roughly half, and by some estimates, closer to 3/4, from the levels seen in 2021, depending on whose accounting you trust. Some trackers watching the exchange in real time put the ratio of outstanding paper claims to that deliverable metal at several times over, a coverage ratio in the high teens on a percentage basis, which is another way of saying the vault could not come close to satisfying every claim printed against it if everyone showed up at once. Nobody expects everyone to show up at once. That has never been the point. The point is that the number keeps drifting in one direction, and a number that only moves one way eventually forces a conversation. So where does all of this actually leave the price today, as opposed to the headline-grabbing peaks and troughs of January? As of the writing of this script, in early July, silver has settled into a range in the high 50s to low 60s per ounce, a level that is simultaneously down close to 15 to 20% over the trailing month, and still roughly 60 to 70% higher than it was a year earlier. Gold, for its part, has drifted back toward the $4,000 mark after its own January spike above $5,500. The ratio between the two metals, how many ounces of silver it takes to buy 1 ounce of gold, has compressed into the mid to high 60s, inside its long-run historical band, but on the cheaper side of it for silver, which is exactly where you would expect it to sit if the market believes silver's industrial story still has room to run. If you've made it this far, you already understand more about how this market actually works than most people who trade it. That is not a small thing, and it did not happen by accident. It happened because you were willing to sit through the mechanics instead of just the headline. This channel exists for exactly that reason, to walk through the parts of a story that get cut for time everywhere else. If that is worth something to you, this is the moment to hit subscribe, because the second half of this story, the part about why the paper price and the physical price may be heading for a reckoning neither exchange can fully control, is where it actually gets interesting. There is an old and slightly uncomfortable parallel worth drawing here, and it involves 30 pieces of silver, a phrase that has meant a broken promise dressed up as a payment for roughly 2,000 years. The paper silver market, in its way, makes a promise every single day, that the number on the screen represents metal that can be had on demand at that price. Rome learned what happens to that kind of promise when successive emperors shaved the silver content out of the denarius while insisting its face value remained unchanged. The coin kept its name and lost its substance, and eventually the market noticed. Nobody is suggesting COMEX is debasing anything by decree, but when the physical metal backing a price-setting mechanism thins out, while the paper claims on top of it do not, you are watching a more polite, more modern version of the same old story. A growing distance between what a thing is called and what it actually is. That distance is precisely what China's export licensing regime widened. Beijing has been explicit, in the case of other critical minerals, about wanting to control materials essential to its own industrial ambitions, rather than simply exporting them at whatever margin a foreign buyer offers. Silver has now joined that list, alongside the earlier restrictions on rare earths and other strategic metals. A doctrine, if you want to call it that, of processing value at home rather than shipping it abroad cheaply. Whether or not Beijing is also building an undisclosed strategic stockpile of silver is not something any public data confirms, and it would be irresponsible to assert it as fact. But the behavior on display, the licensing, the elevated withdrawals, the persistent premium, is entirely consistent with a country that intends to secure a critical input before it needs more of it, rather than after. The historians among you will recognize the shape of this story, even if the metal is new. Oil pricing power drifted from Western trading houses toward producing nations over the course of a single, turbulent decade in the last century. It did not happen overnight, and it did not happen because anyone announced it. It happened because physical control of the resource eventually asserted itself over wherever the paper contracts happened to be printed. Nobody sensible is declaring that Shanghai will set the world silver price next year. That would be precisely the kind of confident prediction serious analysts avoid making, and this script has no intention of making it either. What can be said, soberly, is that the gap between where silver's price is decided and where its physical demand actually lives has been widening, not narrowing. And gaps like that have a history of eventually closing on the physical side's terms. Now, in fairness, and any account that only tells you one side of a story is not worth your time, there are real reasons this could all cool off faster than the last several paragraphs might suggest. A serious slowdown in China's own economy, still wrestling with a strained property sector, would take a bite out of the industrial demand driving much of this. Solar manufacturers have every incentive to keep shrinking the amount of silver each cell requires, a process the industry calls thrifting, and progress on that front, while slow, is not zero. A major new mine discovery remains possible, if unlikely to matter for the better part of a decade given how long permitting and construction actually take. And positioning can reverse violently in either direction, as January's crash demonstrated with brutal clarity. One bank's own outlook this year has silver drifting back toward the high 60s and even the mid-60s over the following year, a far more measured view than the parabola of January ever implied. None of these risks are hypothetical. All of them are worth weighing against the deficit data rather than dismissing. Before we close, one honest question worth sitting with. If a market this large, this old, and this heavily traded can still be blindsided by a single licensing decision on the other side of the planet, what does that tell you about how much of modern finance actually understands the physical world it claims to price? That is not a rhetorical flourish. It is the actual question underneath everything discussed here, and it does not have a tidy answer. Silver in 2026 has been volatile enough to humble the confident and patient enough to reward the disciplined, sometimes within the same week. The deficit has not vanished because the price did something dramatic. The premium in Shanghai has not disappeared because a headline writer declared the story over. And the fundamental tension between a paper price set in the West and a physical appetite concentrated in the East remains exactly where it was before January's fireworks, only somewhat more visible to everyone now paying attention. But Shanghai and COMEX are not the whole map. There is a third vault in this story, older than either of them, and what has been quietly happening inside it deserves its own telling. London does not get the headlines that Shanghai and COMEX have collected this year, and that is, in its own way, the most interesting fact about London. The London Bullion Market Association oversees what is, by sheer volume, the largest physical silver market on Earth, the place where the daily price fix is still set, and where most of the world's wholesale bullion trading actually clears. It also happens to be the quietest of the three. COMEX publishes a warehouse report every single trading day, itemized down to the bar. Shanghai's withdrawal data is at least published and watched closely by anyone who cares to look. London's vault holdings arrive late, arrive lumped together, and arrive without the granularity that lets an outside observer see exactly what is leaving and why. Silence, in a market this size, is not the same thing as calm. Here is why that silence matters more than it should. What data does exist points in the same direction as everything already discussed. London holdings have declined from their highs, and not all of that decline is the tidy, explainable kind. Some of it is exchange-traded fund outflows. When a fund like the major London-custodied Silver Trust sees investors redeem shares, actual bars leave actual vaults, and this year has seen real redemptions. Tens of millions of ounces worth over stretches of just a few weeks, as traders who bought near the top took their profits and walked. That much is not sinister. It is simply people locking in gains after a wild ride, and it would be dishonest to dress up ordinary profit-taking as some deeper crisis. But underneath the ETF flows sits a second, quieter current. Non-ETF metal, institutionally owned, also leaving London, recast into the bar sizes Shanghai prefers, or shipped as is to refiners who can make it acceptable there. One of those flows is noise. The other is signal. From the outside, at any given moment, they look identical on a spreadsheet, which is precisely what makes this such an easy story to get wrong, in either direction, overstating the crisis or waving it away entirely. There is one signal, though, that does not lie nearly as easily, and it lives in the futures curve rather than the vault ledger. It is called backwardation, and it occurs when silver for delivery today costs more than silver for delivery 3 months from now, the reverse of how a normal, well-supplied commodity market behaves, where storage and financing costs mean later delivery should cost a little more, not less. Silver slipped into its steepest backwardation since 1980 in the back half of last year, and flashes of it reappeared around the most stressed days of this January. Whatever you think about paper markets and speculative excess, a market does not pay a premium for silver in hand over silver on paper unless a meaningful number of participants genuinely doubt they can get the metal any other way. Ask anyone who actually sells the physical stuff for a living, and you will hear something the futures screen will never tell you. Talk to the people who run bullion dealerships rather than the ones who trade futures, and a pattern emerges that rarely makes it into market commentary. Lead times for specific bar sizes and specific purities have stretched out. Not dramatically in every case, but noticeably, consistently, in a way dealers will describe as, the market has less slack than it used to. Premiums over the quoted spot price for retail coins, rounds, and small bars have stayed elevated by historical standards through the volatility, even as the futures price itself has whipsawed by double digits in a matter of days. When the price you can actually pay to hold real metal in your hand persistently outruns the price flashing on the screen, that gap is telling you something the screen cannot. that the paper price and the physical price are being set by two different populations of buyers with two very different levels of urgency. One more piece of the machinery is worth understanding, even in outline, because it shows up every week whether anyone is paying attention or not. The Commodity Futures Trading Commission publishes a weekly breakdown of who holds what in the futures market. Commercial hedgers, typically the producers, consumers, and bullion banks on one side, and speculative money, from large hedge funds down to small individual traders, on the other. Commercial players are usually positioned short because that is the nature of hedging a business built on selling physical metal. What analysts who track this report closely watch for is how aggressively that short position gets managed relative to how thin the deliverable inventory has become. A short seller who suspects the vault might not be able to cover every claim tends to behave more cautiously than one who does not. Meanwhile, when large speculative money starts building long positions in the same direction the physical data points, rather than against it, that alignment between paper positioning and physical reality is the kind of signal seasoned market watchers take seriously, precisely because it does not happen every year. Pull every thread in the story together, and you get something more interesting than a single headline number ever could. A licensing decision in Beijing removed a meaningful share of a market that was already short of metal. A price that had already tripled met a leverage-driven crash that emptied out the speculators without touching a single physical ounce. A premium in Shanghai kept pulling metal east through it all. A deficit now in its sixth consecutive year kept eating into inventories that were never enormous to begin with. And in London, in the futures curve and at the retail counter, three separate, largely unconnected corners of this market have all been whispering some version of the same thing at the same time. No single one of those threads would be worth a video on its own. Together, they are very hard to wave away as coincidence. None of this tells you what silver will cost next month, and anyone who claims otherwise is selling you something other than analysis. What it does tell you, with more confidence than most market stories deserve, is that the distance between the price of a promise and the price of a possession has become one of the more important stories in commodities this year, whether or not it ever trends on its own. I would genuinely like to know where you come down on this. If you think this is the beginning of a structural repricing of a metal the world has underpriced for a decade, say so in the comments. If you think this is speculative froth dressed up in the language of scarcity, say that too, argue it, and argue it well, because the comment section on this one has been more interesting than most of the analysis. Either way, tell me what you would need to see in the data to change your mind, because that is a far more useful question than which direction you think the price is going next. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk.